Are you a first-time homebuyer feeling overwhelmed with mortgage jargon? You're not alone. In this video, I'll break down the mortgage basics to navigate the home buying process with confidence. Hi there, I'm Amanda Hagen, a real estate broker in Wine Country, Oregon. I create videos for buyers, sellers, and to share the amazing things my home state has to offer. All right, let's get back to Mortgage 101. If you're a first-time home buyer, navigating the mortgage landscape can feel daunting. But don't worry, I'm here to help simplify the process and empower you with the knowledge you need to make informed decisions. Let's start with some key mortgage terms. I'll go more in depth and add some additional terms later in this video. Loan term. The loan term is the duration over which you'll repay your loan. Commonly, it's 15 or 30 years. Interest rate. Interest rates are the cost of borrowing money, expressed as a percentage. Down payment. A down payment is the upfront payment you make towards your home's purchase. Principal. It's the original loan amount you borrow. Escrow. An escrow account is an account where a portion of your monthly payment is held to pay property taxes and insurance. Understanding these terms is crucial as you embark on your home buying journey. Many buyers ask about the difference between pre-qualification and pre-approval, so let's chat about that briefly. A pre-qualification is an estimate of how much you might be able to borrow based on the self-reported financial information. In contrast, a pre-approval is a more in-depth process where a lender verifies your financial background, providing a conditional commitment for a specific loan amount. While pre-qualification gives you a ballpark figure, pre-approval carries more weight when making an offer on a home. When I'm working with a buyer, it'll be required to obtain a pre-approval to submit with an offer on that home. This is a crucial step in the home buying process. When working with a seller, offers received should also include a pre-approval to ensure that you have a qualified buyer on the other side. When it comes to pre-approval, here are some tips to enhance your chances of mortgage approval. Check and improve your credit score. Work on paying down debts and avoid new credit inquiries. Next, save for a substantial down payment. A larger down payment can improve your loan terms. Maintain steady employment. Lenders prefer a stable income history. And last, but certainly not least, avoid large purchases before applying and during the lending process. Big expenses can affect your debt-to-income ratio. The following steps can position you the best with your team you're building. Your team being you, your agent, and your lender. Just like selecting the right agent for you is vital, selecting the right mortgage professional is as well. So some tips: research and compare lenders. Look into multiple lenders or brokers to find the best fit. Inquire about loan options, fees, and the application process. Seek recommendations. It's a must. Talk to your friends, your family, or a real estate agent for trusted referrals. Remember, the right partner will guide you through the process and help you find the best mortgage for your situation. Now let's chat more about the actual mortgage terms that you'll likely hear when you're working with your trusted lender. First, the term mortgage. A mortgage is a loan used to buy a home. Instead of paying the full price up front, you borrow money from a lender and you repay it over time, typically in monthly installments. Why it matters? It makes homeownership more accessible by spreading out payments over the years. The lender holds a legal claim to your home until the loan is fully paid off. Next, let's talk about down payments. The down payment is the initial amount of money that you pay towards your home purchase. It's expressed as a percentage of the home's price. For example, 10% or 20% of the full price. Why it matters? A higher down payment can lower your monthly mortgage payment. Some loans allow as little as 3% down for first-time home buyers. Here's a tip. Look into down payment assistance programs that may help reduce your upfront costs. The third term we're going to talk about: interest rate versus APR. Interest rates are the percentage of your loan amount that you'll pay annually to borrow the money, whereas your APR, your annual percentage rate, includes the interest rate plus other loan fees, giving you a true cost of borrowing. Why do these terms matter? A lower interest rate means lower monthly payments. Comparing APRs between lenders helps you choose the most affordable loan. And here's a tip: improve your credit score before applying to qualify for lower rates. Fourth, let's talk about fixed rate versus adjustable mortgages, or ARMs. A fixed rate mortgage, your interest rate stays the same for the whole life of the loan, the 15, 20, 30 years. Whereas an adjustable rate mortgage, or an ARM, the rate may start low, but they may change after a set period of time, like 5 years or 7 years. Why does it matter? Fixed rate mortgages offer stability, making budgeting easier. Whereas ARMs, they can save you money up front if you're planning to sell or refinance before the rate adjusts. Here's a tip: if you plan to stay in your home long term, a fixed rate loan is usually the safer choice. Next, what is principal versus interest? Principal is the amount you borrow, for example, $250,000. The interest is the cost for borrowing that money. In the early years, most of your payment is going to go towards interest, but as time passes, your payment will slowly go more and more towards principal, helping you build equity. Here's a tip. Make extra payments on your principal to help you pay off your mortgage faster. Private mortgage insurance, or PMI. What is that? PMI is a fee required if your down payment is less than 20%. It protects the lender in the case that you default, or if you fail to pay. Why it matters? PMI increases your monthly mortgage payment. You can request to remove PMI once you've reached 20% equity. And here's a tip. Consider an FHA loan if you need a lower down payment but are okay with PMI. So seventh, let's chat briefly about loan types. Conventional, FHA, VA, USDA. A conventional loan requires a good credit and a down payment as low as 3%. FHA loans, easier approval with a 3.5% down payment, but it requires mortgage insurance. A VA loan for eligible military members only with no down payment required. And a USDA loan is for rural homebuyers with no down payment required as well. Why it matters? Choosing the right loan type can save you thousands. Some loans help buyers with lower credit scores or minimal savings. And here's a tip. Pre-approval helps you see which loan works best for your situation. Next, the term closing costs. What are they and how much will you need to save? These are fees and expenses, typically about 2 to 5% of the home price, paid at closing, and they include your loan origination fees, your appraisal and home inspection costs, title insurance, taxes and legal fees. And why does it matter? Closing costs add to your upfront expenses. Some sellers may agree to pay part of them with seller concessions. So here's a tip. Ask your lender for a loan estimate to see your expected closing costs up front. And finally, your escrow account. An escrow account is a place where your property taxes and homeowners insurance payments are held by a lender and paid on your behalf. Why does it matter? It ensures your taxes and insurance are paid on time, and it helps spread out large annual costs into smaller monthly payments. Here's a tip. Always check your escrow balance to avoid surprise increases in payments, as taxes do go up year after year. Embarking on the journey to homeownership is exciting, and understanding mortgage basics is a significant first step. If you have questions or need personalized guidance, feel free to reach out. I'm here to help you every step of the way. While this was just like touching the surface in mortgage terms, there's so much more to talk about. I just wanted to get into the terms you may hear as you start embarking on this journey. Take care, have a great week, and I will see you in the next video.